Howdy, it's Mike again, and this should be a fun one. We are going to do another model book stock. We're going to go through Apple, and we're just going to focus on one phase of that because I want to try to make this as detailed as possible, but also something that everyone can get through. So if I did the entire run, it'd probably take 5 hours, and I don't, have the patience for that, and I'm sure you guys don't either. Tip: watch these back at like 2x speed. If that's too much for you, then dial it down to 1.5. Or if I'm going over something that you need time absorbing, just put it on standard. But I listen to all my things at 2 times speed or faster if the program allows it. So anyways, we are going to go over Apple, and let me just share with you. Let's see, share screen. Oh, I messed this up last week. Okay, so this is this is the Apple portion that we are going to focus on today, and this is what Bill O'Neill, how he marked it up in a little program or a little series that he did in the newspaper. And I'll tell you that Greg Morden out of same town as Marcus King, out of Greenville, South Carolina. I think I have that right. Well, I think you're close enough, Greg, if you're not there. Scanned all of these in, and he put it in on as his pinned tweet on Twitter. So I'm going to share that. You know what? Let me stop share for a second. I'm going to share the, or actually, we could just do this. I have his up. So G Morden 512. So you can go ahead and great guy and puts out a ton of really cool info, like so many people on Twitter do, or X, old habits. But just go into his pinned tweet in there, and then you can find all that information. So let's go. This is what we are going to focus on now. If for those of you who cost really isn't an issue, and I'm doing these for videos for people where to have something that's free to do. What I'm hoping is kind of high level information. And I really got this idea from someone I really look up to, Andrew Huberman, and I love his podcast. And he takes a lot of kind of intense stuff, and he does long format podcasts, mainly on health. And I would say he's had a tremendous positive impact on my life and my family's life. So definitely check his stuff out. But that's where I got the idea. But if you have if you have means to spend, IBD does do a home study. I don't get paid for any of this stuff, so I'm not trying to promote it for that. But where Bill walks you through, I guess 12.5 minutes on Apple. And this is how he marked it up there. And you get to hear, if you've never heard his voice before, heard him walk through models. So he has a whole bunch there. And so I think they've discounted it to around 1,500 or so. It was originally like $3,000. And frankly, I think it was underpriced at $3,000 and crazy low at 1,400 for what these model books are. And I'll just, so this is from there, just go in and, if that's in your, if you can afford it, do it. If not, build your own and watch these videos. And, at some point you will be able to. Let me see. I'm going to stop sharing. Man, it scares me every single time. Why am I having trouble? Well, this is problematic. Does not want to let me. Let's try this. What if I just get rid of that? No, that didn't do it. Okay, yeah, that'll let it. All right, so sorry about that. If I could edit this stuff out, I would, but I can't, so I won't. So fast forward. Anyways, the the model books, and I don't think people realize this based on a comment that I heard about 2 hours on how to build a model book was like too much. model books were under lock and key, and the only people that had them were Bill and his portfolio managers. And analysts there, when I was in research, I had to ask one time one of the PMs for a book to photocopy, and he kind of stood there and let me photocopy, and it was forget what it was. I was thinking it was 1998, and I was thinking eBay was a high tide flag, and so I think I asked him to look at syntax because there was no other way to get syntax, and so they were really locked down, and I built a ton of model books for Bill during my time there, and even those, I mean, we would number them. We would only make a certain number of copies, and eventually, when the firm got a little bit more liberal with letting other people use them. We'd have to sign them out. So, I mean, these are a big deal. I had to leave mine behind when I left. All of the ones that I built, spent my countless hours. But that's how seriously it's taken, because everything that Bill did came out of these model book studies. That's why we go through them, and that's why I'm going to do this series on walking you guys through ones. And anyways, if that's in your wheelhouse or in the cards for you, then, I would get their home study. But anyways, so we're going to go through Apple. And if you look at how Bill did it and went through it, let me share that again. Let's see if that is going to give us that same problem as last time. Okay. So with this, he's, starting off at the very beginning. This is what the problem is. Okay, he's starting off, at the very beginning, around here. It's probably hard to kind of see my cursor there. And then not having any cells the whole way through. And that's not realistic. And I'll tell you why that's not realistic, because I was a PM during this time, and we traded it, and we weren't in it the whole time. And so I'm going to kind of walk you through reality of how you could have handled Apple during this, and more than using kind of a hindsight of you buy it at the beginning and you sell it at the top and you figure out a reason for it. I'm going to walk you through along the way that, if you're trading slow or fast, where you would have added, where you would have sold, where you would have been out of it completely. So with that said, we're probably 3 hours into this podcast already. So I'm going to stop that share, and we are going to share Apple using Markets Surge. And let's see. Okay, so here it is on a monthly, a current chart as it stands right now, and we're going to study the time frame here from 2004 up to 2008. Maybe I'll do another one in the future doing this time frame, but right now we're going to focus on this, which was a huge advance in the firm, including myself. We made a ton on that in it during that time frame, but I'm going to walk you through the mistakes that I made that would have allowed me to capitalize on it more than I did. And so anyways, we're going to start off down here. So I'm going to, let's do a change date to 04. So you just go up to that change date up here and you change it to 04, and I'm going to go on the standard view here. So, and we'll just blow this up a little bit. So this was the history of Apple. And if you know anything about Bill, he would look at the history a lot to be a guide for what to expect in the future. And that was, that's how I look at it as well, is just, what's the stock's character? And the best way to do that is look at a monthly chart and look at it over a long period of time. And where I focus my eyes is on the relative strength line, which is this green line here. And then on the green line there, sorry. And then these moving averages, and look for times where it's leading that and staying above those moving averages. And so you have this period here where it really was able to pass all of those or outperform the S&P, but most of the time, from here to here, it underperformed. From here to here, it underperformed. I'm sorry, I'm fighting a cold. Went to see Marcus King on Thursday night. He didn't start until 10:30, and we didn't get home until like 2. So I think I caught something there. But man, it was like a venue, the Continental Club here in Austin. Never been there before. Very historic, and I'm paying the price for it now. But man, I would do it all. I would do it over a million times. So again, check him out if he's in your town. I believe he's heading off to Australia and New Zealand shortly. So if you're watching from over there, I think you can catch him. So anyways, I was just fighting a cough. So with this one, why this is important, the history of it, is this was a dog up until '04. And this is something that I would have never given to Bill O'Neill at this point because it was really problematic. Let's look at it on the weekly chart. So in here, you have this bad, terrible break in September of 2000. That was, let's just look at the NASDAQ during this entire time frame. I kind of squish this in here. And so this was the bubble bursting. So if you're new to investing and you never traded during this time frame, you really, it's sad because we all learned so many lessons during that time frame because you had to do things exactly right and you would still get killed. But if you didn't do them exactly right, man, there was hell to pay. So during bear markets, and I remember, during this 2002 time frame, Bill would always say, "Oh, this is the best thing that ever happened to you guys. This terrible bear market because you're going to learn all the things not to do." And I hated when he'd say that because he said it more than once. But now a couple decades later, I realize how right he was. I just did not want to hear about this, and I've got great stories about this time. Probably my best stories are around this time frame, and in some discoveries that I've made with 1929 to 1932, the same as 1999 to 2002, and I'll definitely do a video on that one. There are lots of lessons learned there. But anyways, we are going to go back to Apple on the weekly chart, and why I brought that up was this is when I discovered Apple was during this handle, and I didn't give it to Bill because I knew that he would have just bit my head off if I would have suggested this to, again, our institutional product or NESME list or new stock market ideas that I discussed on one of our last videos. Because we could only trade the stocks that we had on that list. So the PMs would want to get stocks on that list so we could trade it in our account. So let's say Apple wasn't on the list and you wanted as a PM to trade it in the firm account. You couldn't. You could trade it in your own personal account, but you couldn't trade it on the firm until we got it on the list. And during this time frame, there was like a 48-hour window where we'd put it on. We'd let our clients have 48 hours to do their due diligence and buy it if they wanted. And then we'd have free reign to buy it if we wanted. And then that time frame changed later. But anyways, so I never would have recommended this, but my good friend Charles Harris did recommend it to Bill during this time frame and put it on because he wasn't having to recommend things on a daily basis. So, I was having to do it on a daily basis and as well as every Sunday, and the rest of the team could just, kind of cherry pick and every once in a while just give a name. And so because of that, Bill would typically just say, okay, if someone called up with a name, go ahead and put it on. But I never could have because he would have just said this was horrible. And there's a reason why I'm talking about this. And because during that time, during that handle portion is when I discovered Apple. Now, I always knew Apple was around because my parents were educators. My mother was a school teacher, 4th grade, 5th grade, and then eventually a principal for elementary school. And my father, after he retired from the Marines, he coached basketball and taught at high schools. And so they were, if you knew any educators, they were all into the whole Apple ecosystem. And once you get into the Apple ecosystem, you stay there, as per my, you know, I don't even know how many iPhones I've bought. I've only bought iPhones. And probably always will, even though they're really not that good anymore. You just buy a new one when your battery stops working, or it stops working. But that's because Steve Jobs isn't around, and frankly, Tim Cook is not Steve Jobs. Sorry, dude, it's true. But anyways, the point is, the only people that use Apple products at that point were educators, and as well as people that were doing like audio visual, like editors and things, people who know how to do videos would use it. And so it was a really small segment. It was like less than 2% of the people used those, and everyone else used Dells or other PCs. And when I was a Dell person, I would make fun of my parents for using Apple products, and they would always say how great they were, and I was closed-minded at the time. And I was just like, no, that's silly. Plus, I was using TradeStation, which didn't offer a way at that point to use Apple products. So it was just kind of like, no, this is my favorite product. Why am I going to buy, an iMac or enter the MacBook Pros or any of that type of stuff? But so anyways, this was like a stock that was a dog. No one liked it. But what happened was, and I was searching for it and I couldn't find it. But during that time frame, I was gifted an iPod. And at the time I was using this old, and this is before iPhones. This is an '04. I was using an old WRO MP3 player for my music. And obviously I'm into music, and it sucked. You could put this little card in, and it was just terrible on every level. And I'll never forget, I was at the Olive Garden in Manhattan Beach, meeting with some family members, and this one family member, an in-law, gave me this iPod in the case. And she had gone to watch, I think it was Oprah, either Oprah or Ellen DeGeneres, and I think it was Oprah, and gave away to everyone in the audience all these iPods. Now, I think it was a second generation, and I had never even seen one. I had just poo-pooed all Apple products. And anyways, we're sitting there at it was a really nice gift, but this person didn't even have a computer, so there was no way to hook up and didn't listen to music really. So, she gave it to me. And I'm sitting there at Olive Garden. My kids were just little at that point, and I'm just mesmerized by the packaging. I'm like, oh my God, I hadn't seen a company do such a good job with packaging. And this is why Steve Jobs was so important. It's like down to the very smallest detail of just the box and how everything opened up. And we're sitting at this family dinner and or lunch, and all I could think of is I cannot wait to get home to see what this Apple chart looks like, because I'm just blown away with the packaging. And then I take the device out, and it's just beautiful. I'd never seen anything like it. It was just elegant. And all I could think of is I need to get home, because I didn't have a phone at the time where I could just go on Market Surge or, a different app and pull up the chart. This is back in the day in '04. So I was tuned out the rest of the thing, and as soon as I got home, I went straight to the computer, and I'm like, oh my God, this looks so beautiful. And I will just give you a sense of, I've kept all my Apple things. That iPod is somewhere in the garage in one of my boxes. I haven't gotten rid of it, but I used to, after that product, and when I was trading a stock, I bought everything. And here, I've got all my old Apple phones. This is, I believe they called it, well, I don't even want to say, but they had a name for these first Apple iPhones, and I waited in line. I was one of those geeks for it. Still have that. There one product that was great were their Apple TVs, and I bought all the versions of of these. This was their first one was the best, but it would overheat. But you know, Steve Jobs was just on top of everything with the iPod. Then they came out with the iPod Shuffle, and some of us, Justin, myself, and some of the other people who work closely with Bill, we bought him an iPod Shuffle once for Christmas or his birthday or something. I don't think he used it. I think he gave it away. But I was needy. When I get into something, I put my Peter Lynch hat on and I buy all the products or use all the services because I want to know if it's good or not. I know there's a long backstory on it, but you've got to remember that the charts that we're studying aren't just lines on a chart. It's a company, and there's a CEO behind it, and there are people behind it, and there are products and services and decisions that are made that either make the stock go up or make the stock go down. And never forget about that, and don't just think of it as a symbol. Always, put your Peter Lynch hat on. If you haven't read One Up on Wall Street, Peter Lynch book, go get it. You can finish it in a day, maybe two, and it will really change how you look at the everything. Whenever you're shopping, you're always going to be paying attention. You're always going to have your phone with you and searching and seeing, like, is this a public company? And if so, what does the chart look like? So now we'll get back into the chart, and I'll try to stop going on so many tangents. But I do think that was, important. Frankly, when Bill would go off on tangents when he would teach, and we taught workshops together, and I just remember his tangents, the little stories that he would say, not all the intricate little details that he would say about a chart. It was more the other things, the red dress story, if you've ever heard that, or the turkey story, or the Quicksand Dead, or, it's not your Aunt Sally, or the elephant in the bathtub, and all these things that stick with you. And so that's why I do my version of it. My version's just a little bit longer, like 100 times longer, but it is what it is. So let's see where we were on here. So here's, in fact, it was a little bit before that. It was, I think it was right when the handle started. So it was probably around January 22nd, or, well, it would have been the 23rd because it would have been on the weekend. So this is what it would have looked like at that time. And I was blown away. I'm like, how could I have this thing happen where, I'm at Olive Garden, I've got this iPod, and I just got to buy this stock. And I hadn't traded options in my account since like 98, I think. I just stopped doing options, but I believe, I'd have to go back and look, that I actually bought options on this during that time frame because I was so convinced. I'm like, this is like a game-changing company. And of course, it ended up being. But anyways, so it was in here, and then, let's fast forward a little bit. And it's somewhere in here where Charles mentioned to Bill to put it on our NESME list. I'm not sure the exact date, but it was somewhere in this cup with handles. So I was just shocked. So let's just go out a little bit. The handle lasted pretty long. So here is our breakout 3-4, March 4th. So probably somewhere around here. But it was, in here where I started buying it, and you do get some false breakouts in here, which does happen. And I will tell you, this is not a perfect base. And let's just go back 1 week before. Now, we don't store in Market Surge what the ratings are, but at this point, from memory, the RS rating was probably, I think it was 54 this week, which is why when you're screening for stocks, you don't want to only screen for things that have an 80 or 90 or higher. Even though those are your best candidates, you're going to miss the next Apple if you do that. And so I think a few weeks before that, it was even the RS was even in the 30s. Now remember, the RS number is different than the RS line. This is your RS line, the green line. That's versus the S&P 500. Your RS number is a 1 to 99 number, and the ones are the worst, the 99s are the best, and it's over the last year. And currently, it double weights the most recent quarter, and each of the earlier quarters are equally weighted. So if you've got RS of 99, that means you beat every stock in the database on that. RS of 1 means you're the worst percentile. And so, the 54, 55-ish range, that's really pathetic. But, it's something to remember. There are exceptions to everything. Now let's just take a look at this weekly base. And, I know Bill has said, that it was a perfect base, but it really wasn't. And I'm going to kind of walk you through why it wasn't. So sometimes it's not the technicals; it's the technicals will give you an entry point, but it's the fundamentals and the story behind it that makes the move. So in isolation, if you look at this base, really wasn't that good. And let's just blow this up a little bit. Let me turn standard back on. Okay. Actually, in this case, the best fit will allow us to do this a little better. Okay, so when you're looking at a base, you want to start off analyzing the base with your first week down off your closing high. So this is on October 10th of 03. That was your closing high. So in the Bill style, you do it. You start measuring with your first week in the base, so your first week where your close is less than your closing high. So that's this one. That actually opens up a huge can of worms, but we won't get into that today. And you analyze the bars one at a time. And since this was back in the day when volume was clean data, I'm going to walk you through how I would analyze them together. And it's something that Bill came up with years ago, the week by week analysis, and then the two of us worked on that for years together, trying to quantify. If 1 week does this, the bar does, has this pickup in volume and closes up or down this much, and this much of a closing range, and this much of a spread, and in relationship to its moving average, this or that, and give it a +1 or a -1 or a +2 or what have you, and then tally it up the entire base and then see what that rating is. And that's a project that we worked on for a long time and never finished. Sad we didn't finish it, but he retired before we could get that completed, and something that I'll dust off at some point and finish. But anyways, I'm going to walk you through that week by week analysis that we would do and just be objective about it, knowing that I loved this one and we made a ton of money off of it. Your first week, you're down 3.93. So you look at the in the little track price, 3.93. That's a big break. But more importantly, your CLS range, closing range of 13, that's telling you you're closed near the bottom. A 0 would be the absolute bottom, 100 would be the top, 50 would be in the middle, and you'll see why that's important as we go through. So what I used to do is I would print off the charts. I told you guys that the last time is I print off the charts on my drive home and go through them and then mark them up. And I'd take a red pen and a blue pen and I'd mark up in the base with a red pen anything negative and a blue pen anything positive. So the first thing you do is mark with this first week is a downside reversal, meaning you had gone higher and you closed down near your lows. You were down a lot. 4% for the week was a lot. At the same time, you can see the S&P, which is this black line here, is moving up. Let's just toggle over to the S&P, do some three-dimensional chess. So as the S&P is running up, and let's look at the NASDAQ, NASDAQ is running up and Apple is base building during the same time frame. So that's problematic. So that's a negative against it, but down 4%, essentially down at the bottom. So I would take a red pen to that. Now your next week isn't really that bad. You're only down 0.66 on that week, and you can see that the volume down there dried up. So you're always, if you're using volume, which I know everyone else does but me, and so that's why I'm going to talk about it. that you're using it versus your prior week and everything in the base at that point. And so your analysis would be saying that, okay, your selling pressure happened on that downside reversal week. The next week, that was your lowest volume going back a long, long time. Now, that tells you that there weren't really massive sellers in there. And also it didn't close down that much. It was only down 0.66%. So the selling pressure subsided. So that was really 2 weeks tight at that point. Now you get another week in there. It's up a little bit. And this one is actually a negative week in a lot of ways, because even though it's a blue week and the volume picked up versus your prior week, your closing range was 31%. So going up and then closing in the lower half. Also, the fact that it couldn't stay above the high there on the October 10th is a negative sign. So you can just tell, there was selling pressure there and it closed well off the highs. Now, what was good about it, it was almost unchanged for 3 weeks. So even though when it's blown up here, it looks kind of wide and loose there for those 3 weeks, it really is, tight on there. In fact, we'll go back to the standard fit, and you can see that that's really, kind of tight action. But we'll go back to this stretched out way just for this. So again, first week, negative, red. Next week, actually relatively positive, so either a black pen or a blue pen. Next week, it's a red and blue, but mostly red because of the closing range. The next week, an inside week, meaning your high and your low were contained within the prior week, so that's good, not new price discovery. Did find support right at its 10-week line, which is that red line, which is similar to a 50-day moving average. And since it didn't break the prior week, that was actually, good. But on the downside is your volume picked up and it was your second highest volume in that base, closing down on the week. So that's not something you like to see with a closing range of 6. So again, there was a lot of, there's a touch of gray in a lot of this stuff. So it's not necessarily all red or all blue, it's mixed. So the inside week is positive, closing range is negative, stopping at your 10-week line is positive, the pickup in volume is negative. So this is what you're doing, and you should get this ingrained in your mind that as you go through a base, you can just instantly see it. I mean, I can see that in a second, just when you've been doing it long enough, you just pull up a base and boom, it's good or it's bad. Maybe if you have to, you can, spend 10 seconds on it, but this stuff will jump out at you. At first, it'll take you a little while. Once you start doing this, it'll just jump out at you, or it should. So next week, very bad. Okay, down the most for 4.62. So it's his biggest decline during the base so far. So again, this is all we know. Let's do a change date and go back to. So another way of doing it is kind of, so this is all we know at this point. So let's just kind of go through it this way. So as because your mind will play tricks on you knowing that it comes back. Say what's good about that week? Really nothing price action. The only thing is good is you didn't get a lot of selling pressure there because your volume dried up a bit. And so now let's go out. If I do it this way, we're going to be here until next year. So I'm not going to do it. I know me. Got to learn from my mistakes. So we're going to go back out. But that's how I would suggest. Just go at it 1 week at a time, do the change date, and that'll help you get used to things. So your next week, that's also down. Now that is down the most because your first week you were down 4% essentially. Then you're down 4.6%. Now you're down 5.5%. And you're closing at 28% closing range. So selling. So there's not really much good there. And your high is well underneath your 10-week line. And the only thing good is you kind of stopped in the middle of this kind of little flat base over here. So, you should stop there. Then I'm going to speed up a little bit because I'm even getting bored with myself. Yeah. I heard you there. Remember, you can pause this if this becomes not fun or enjoyable. Just pause the video and come back to it when you're mentally ready. So you've got 3 weeks that are closing almost unchanged there. So that's positive, and that's why with pattern rec, I've shaded it blue there, and you can hover over it and see 3 weeks tight, 3 weeks tight there. So that's very positive. You have 4 weeks tight over here. So that's all good. But in here, you were having trouble running up against the 10-week line this week as well as this week. So it was clear resistance, and your 10-week line was in a downtrend, which is negative. But what was positive about it, besides the 3 weeks tight, is really this bottom week. They got support at your 40-week line, big spread, up 5.5%, 92% closing range. Really ideal action, and you combine that with this 67% closing range and this 65% closing range. So it's starting to get support in there. Now, what's not good about it is the volume was a lot less than your prior week. So that's a bit problematic. But then you look at the date there, well, it's right around Christmas. So you want to always take it with a grain of salt. Now, I will tell you, back in the day, I did, I'll stop share for a sec. I did ask Bill once about volume on the breakout, because he was always wanting volume on the breakout on the week to be higher than the prior week. It was a big deal. If it wasn't, he would say it was flawed and, you shouldn't buy it, you should avoid it. So I remember, being kind of that pesky, kind of like the 2-year-old who asks their kids, the parents, all these questions. Well, my kids were never pesky. They always asked actually really highly intelligent questions. And I'm not kidding. They're just brilliant kids, but brilliant young adults. They were brilliant kids too. But I asked him, I'm like, well, Bill, what if it breaks out during a holiday week? Doesn't matter. The volume's either there or it's not. And I'm like, okay, well, what if it breaks out on the Friday of a Thanksgiving week? Because it's already a light week. You're no trading on Thursday, and Friday is a half day. And so I'm like, what if it breaks out that week? And he just turns to me and is like, Mike, it's either there or it's not. No excuses, no alibis. So I shut up, man, and I stopped asking any more questions. But that's what he would say, but what he would really do would be different. And so, he would use that context. But so that was what was unique about him. He could really compartmentalize and go rules, rules, rules. It's black and white. But he would use a touch of gray when it came to really trading. And so I always, it took me a long time to realize that what he said wasn't really what he meant. But he believed what he was saying. So he wasn't like lying. He was just, no excuses, no alibis, Mike. And never forget that. Just cracked me up. Because I'm like, a little OCD. Maybe I'm, I have Asperger's or something. I'm not sure. I haven't been diagnosed, but, probably. And so, things are a bit black and white for me. With things, and that's why when I go through these, I'm kind of like, okay, this is my black and white of it, and I'm just kind of hardwired that way. So let's go through this. I'm going to share this again. Okay. So trying to not mess this up. All right, so we were back over here, holiday week, light volume. Now your next week, you actually close back above your 10-week for the first time, but your 10-week is in a downtrend. And the closing range is 47%. So for a blue week, that's really not that good. So that's again why I was saying that this base isn't that good, and the volume is less than your prior week. Again, it's still holiday time. Now the holidays are over, first real week of January, and you get this big move up, biggest move in the base in either direction. So up 8%. What were some of these other ones? So that was down 5.7%. That one was down 5.5%. So that's a really big week, closes 58% closing range. So lower than what you like, but now your low is back above your 10-week line. Again, a low getting above a moving average is more meaningful than a close getting above it. So the week before you had your close slightly above it or at it, and then now this one is well above it. Now your next week, and this is why I say it's just not good, your highest volume in your base is a downside reversal closing at your lows. There's nothing good about that week. There is just nothing good about that week, period. I could use a bunch of hindsight because I know all the hindsight, but there's nothing good about that. But what was good is 4 weeks later, you're almost unchanged. So you have this bad, heavy selling with the highest volume. And then for 4 weeks, it holds in there tight, almost unchanged with your last week in there. That was a really good week. Your highest volume of, those three, closing near your highs, 83% closing range, finding support at your 10-week line. So that week, very good and it's very subtle. Following week, really stalling action, not good. Next week, you notch out a lower low than your prior week, closing in 13% closing range, not good. Then on this week, that's good action. And no, we're not going to do week by week through the whole thing. I know what you're thinking. But I just wanted to give you a sense of what you would do on a base. And so that was very constructive. Let's go out. Let's just go out to April after it broke out to kind of see what had happened there. So that was your really good week. And then now here's your breakout on 3-5. So let's go back to 3-5. So here is where it breaks out. And now that's your highest volume, blue volume there. So this volume was a little bit higher. That was 56 million shares. This was 53 million, but your highest blue volume going back to this big week off the bottom there. So let's take off the silly best fit and go back to a normal one. Looks so much better. So this, you can hover over it and you can see that it's a first stage base because this base undercut the low of that little flat base, kind of reset things. Depth is 23%, the handle is 13%. All that stuff is good. And your volume, no excuses, no alibis. That volume is higher on the breakout week than your prior week. So it's got Bill happy there, and we were all in there trading it, or at least, several of us. And let's go over to the daily. And so with this one, what you have to remember is there are going to be false starts in there where you would have bought it and then been shaken out. And so you want to go through that. So here, let's go on 210. And this is why I'm going through this and how you should all do your model book studies at home is pick something and go through it and then go back and change the date and ask yourself, what would you have done? And how would you have handled it? And frankly, I would have bought it on this day, on that day there, and then would have been selling it on that day because it broke my expectations. My expectation was you had a little downtrend in your handle, it broke it, and it's stalling already. So lots of times these alternative pivots, will give you a lot of false signals, but then you're getting it before the standard pivot of the 28 or 24.84. So I would have been out of it there. This was in a little bit too weak of a position to really buy it, but on this day, on 210, that was clearing a prior resistance area there. Bill would buy a lot on prior resistance. Let's clean this up a little bit. So the resistance of these days there, and it's going above it. So you can, nibble on it. Let's go out a little bit. Let's go out to the end of that week. So if you're buying it there, you're adding to it here. Now you have this bad day in there, but you're still up on your initial position. So you might have sold what you bought here on that day and trying to hold that. But if you sold the whole thing, there's nothing wrong with that too. I might have done that and just said, okay, if it comes back through there, I'm going to buy it back. Let's go out a week. Okay, so let's say you held the whole thing on this day, not really giving you any info, you can still hold it. not giving you any info this day on the 19th, then you're selling that. And just be intellectually honest with yourself. Your RS line is poking back down. This thing has been a dog. So look at the weekly chart. The history of it being a dog. It's closing down, and it looks like it's a magnet for 2170. So you just exit it. So again, I've probably bought it here, sold it here, bought some here maybe, but really bought it here, bought some more there, sold some there, and was out of it here. So when you look at a chart, that's what you should see in your mind of all of your trades. Now, that's probably too active for many of you. So then you could look at it and just say, I'm going to just wait for a standard pivot. I'm going to just wait for it to go above this. There's nothing wrong with this. I'm walking you through how I analyze it. And you should do it your own way. There's not a right way. There's a right way for you. So let's go out a week. So would have been buying it back here. Like, look at this. Now it looks even better because you had your shakeout. You can draw your declining tops line there. Big pickup in volume, closing near the highs, up 3.82% on the day. That looks solid. And that RS line right there, poking back up through those short-term moving averages. So let's go out another week. So now a serious breakout, right? So we had our downtrend here, buying it there. And these days it's doing nothing. Like, being intellectually honest, you don't have to sell it there. It's not doing anything wrong. But you're adding heavy there because now it's moving back through that prior resistance. And so I'd be adding to it there and then adding to it over here. I don't remember what I was doing, frankly, at the time. I know like I said, in my personal account, I bought some options in there. And typically when I buy options, I give them a little bit more time. I don't do a lot of options, and I don't do options well, frankly. So, and I just keep them simple. I just buy calls, and that's how Bill would do it. He didn't sell options, or he would just, keep it very simple. But anyways, now you've got a real breakout. Let's look at this on a weekly. That's a solid breakout. So if you didn't do anything and you're just waiting for that standard pivot, that's where you buy it. But I'm going to have bought it there, added heavy, and added more. And you just have to know what the end is, like how deep in the market do you want to get. And we talked about on an earlier one. For these, I'm going to just say your ultimate max position in anything would be 25%. Now, for some of you, that might be 5%, might be 2.5%. Remember, these are not investment advice. Do your own. I'm not an investment advisor. That's a blanket statement for all my videos. In case I forget to say that, you need to find your own way, do your own due diligence. But I'm just walking you through how I would do it. And so I would know that, okay, like 25% is my max. And normally, let's say, start off with a 7.5% position. Let's say over here, where would I want to be on this? And I would say maybe a 15% position. So I'm not going to ramp it up to my max right away, but let's say 12.5 or 15%, given those numbers. So now we go out. And so that's as much as the bar by bar that we're going to do, because otherwise we'll be here all year. And my better half is waiting for me to go eat, which is kind of how these Saturdays end up working out these days. So now you've got a good move out of here, doing nothing wrong. And this is what you want to do, is study how stocks break out. And on this day here, some people, let's go to the 8th. Some people would be like, oh my gosh, it's down, down 2.7% from the close of the prior day and way off the high from the prior day. I look at that as beautiful. The volume dried up and it's an inside day. Like, it really could have come all the way into here and still been totally fine. So that's what you want to get in your eyes. So let's go to the end of this month, see what we can learn from this. So with this one, had its first pullback in near the pivot area. 50% of the stocks will do that. That's normal and natural, and got support right at your 21-day moving average, which is a good sign that your 21-day might help you out with this one. That's your green line. And let me just go over our settings, because I get this question all the time. These are my moving averages. This is how I set it up. The only thing that's not normal Not a default is a 21-day exponential on here, and then the 10 month and the 24 month, and I use simple for those. And then for my what's more important, for my relative strength moving averages, these are the settings that I use, all simple on here: a 21 day, 8 week, and a 10 month for the default RS. I call that the RS1. And then the RS2, I use a 50 day, so that's this blue line here, 21 week, and a 24 month. So those are the settings, and this kind of will tell me, it's something I developed over the last few decades, that it tells you how it's doing relative to the market. Is it truly a leader? If it's a leader, by definition, by the most simple definition, it's outperforming the S&P. Well, for what time frame? So that's why I use these different moving averages to smooth that out, because on this one day, that's down 3%, and let's see what the S&P is. The S&P's only down 0.07. So on that very basic level, on that day, it's not a leading stock because it was down more, but that would be silly to look at it on a daily basis. So that's why we smooth it out with the RS line, your green line here. That's how it's doing versus the S&P. And then these moving averages that I developed, I'll do a whole video on that. So it's still above it. So we're going to go out. Let's just go out to the end of April. And here's our first test of our 50 day. So during here, we undercut the 50 day, and now you've pretty much round tripped everything. And more importantly, from a short-term standpoint, your RS line is going back through both your short-term moving average and your 50 day. So if I'm swing trading this, I'm back out of this, even knowing what ends up happening later. So then your question to yourself is, am I swing trading it or am I position trading it? If I'm swing trading, I'm using the RS lines on the daily and saying, okay, my first sell signal was when the RS line went through its moving average there, the short-term one, the 21 day. And then when it went lower than that, that's my quicksand rule, so I'd sell even more. And my final line would be what I call the Grateful Dead signal, grateful to still be alive, and that RS line is going through its longer term one, the 50 day, and so I would exit my position there, being willing to buy it back. Now let's go over to the weekly. Now on this one, so if I had done the fundamental work on it and said, you know what, I'm going to position trade this one, then I would still have some in there because it just has pierced through. Let's do the week before. The week before, your RS line was still above its short-term moving average. And again, that's, if you go over here, relative strength line moving average, we're on a weekly. Your 8 week is your short-term, and your 21 week is your long-term. So it's still above that, so we're not taking any action. We go out to over here, and it has poked through and given you your quick signal. So with that one, you are going to have to sell some of it, but your RS line is still above your Grateful Dead signal there. And again, this is just a hold winning position. So if you've run your cost basis up higher than that, then you would sell that. But it's just any of your core position that you're still up on, would I use those rules. So let's go out. Let's go out just the end of the month, because otherwise this will take forever. So we're the end of May here, and it's just base building, and it's just in here, and the RS line is poked back up. And now I'll tell you a funny little story. We used to have PM meetings when really Bill was like not in a good mood or something, and it basically means he would not be in a good mood if we mishandle something collectively. The team didn't handle something right, and so we would meet to review whatever we went over, and we were human and we made mistakes all the time. And so then, he was the master, and so he would teach us, and we were all, grateful for that, frankly. I was. And it wasn't always fun, but I was very grateful for that experience. But I remember how close-minded we were all to Apple. And I think the only people at the time who realized how revolutionary or this company was at this point was really Charles and myself. And we weren't talking about it with each other. I don't think we talked about it till a long time later. And there were about 10 PMs in that meeting, and I'll never forget. We were going through the NESME list and just seeing like, oh, what was on there and talking about it. And then the subject of Apple came up, and it was somewhere in around here. And Bill was pissed that was on the list. He's like, and the first person, the guy who was running the machine, I won't mention his name, didn't know what the symbol for Apple was. Bill said, let's look at Apple. And he didn't know. And it was funny. Charles and I just kind of kept our mouths shut, and everyone was like, is it APLE or is it blah, blah, blah? No one even knew the symbol of it. And it just cracked me up because, with revisionist history, everyone knew that Apple was Apple at the very beginning. But no, because it really hadn't performed. And again, Bill had every reason for that, and everyone had every reason, because unless you saw the product, this has been a dog this whole time. It was the same price that it was, prior to the crash of '87. So they weren't wrong at all. It was just the reason why I bring this up is to not put anyone in a good or a bad light. It is just the reality of don't have a bias towards something. If there's the new product or service that comes out, you need to change your mindset. And I'm talking to myself as well, because I have certain companies that I have a negative mindset to, and I'll just be frank, is Meta is one of them, and I mishandled Meta because I just have a negative bias towards it, and need to change that. So I'm talking to myself. So anyways, I don't have a position in it right now, but I should. But during here, no one liked it. Bill wanted it off the list, but somehow it slipped through the cracks and stayed on. Again, staying on the list allowed us to still trade it. Then it breaks out in a great way. Let's go through the breakout. Let's start over here on 525. So here is not a Bill approved way of trading, but something that I've incorporated in my style now. That as you're rounding out the right side of a base and you make it back through your 50-day, and typically your 50-day, if it's flat or increasing, it doesn't work so much if it's in a decline. But then I'll start buying it, through over here, and I look at this, and you look at the day here. Let's go back one day and just go, well, why would you buy it there? Well, because at one point during the day, it was trading up there and it looked like it was breaking over that prior resistance. And so now your question is, if you bought it there at the highs of the day, which I probably would you have sold it by the end of the day? Well, it just depends on your rules. I probably wouldn't have. Now you go out another day and that builds on it. So if I had sold it, then I would be buying more of it back here. So let's say I originally bought it over here, bought it over here, and that I was worn out of it and I sold it over there because I was, broke the 50-day and my Grateful Dead signal was there and everything. And legitimately, that's how I would trade it now if I was looking at it, and unless I had seen the iPod and everything. And I would be swing trading this at this point because it had been a dog. I'd classify this based off as a C at best. But, it's going above that area there, and that RS line is poking back up. So I would be, and your volume is picking up versus your prior days. So I'd be, buying that. Now let's go out to the end of that week. And it's pulled back in, but not doing anything abnormal. Volume's drying up, and it's just rounding out that side. So all looks good. Go to the end of the next week. So here you had, I know it's not long enough to be a traditional handle, but for me, 3 days is enough. For Bill, he would want 5 days. Not a right or a wrong, just different. And so right there, I would look at that as a cup with handle and be adding heavy there. So here adding some there, but adding heavy because it's a standard pivot. Let's go out another week. And now it goes through your standard cup without handle buy point. So let's go to the 7th. So you look at that. Now your question to yourself is, okay, maybe you missed this entire run, which was completely legitimate. Or let's say you mishandled it and you've only lost money in this, which is totally plausible. You have to be, like what Ted Lasso says, and be a goldfish and just, have a 10-second memory and just say, forget what I did before. I'm going to buy this back. It's the best it's looked. So you had your one base breakout here, this little kind of, you can call it a square box type of base on base. Then you have this cup without handle here, and it looks the best. Your RS line's poking into new highs. Let's see what it looks like on a weekly. Looks solid. That's the best that it's looked. And no excuses, no alibis. Your volume is higher than your prior week. Does not have to be above average. Okay, so let's go out. We'll speed this up. I've said that before, haven't I? Let's go out to here and out another week. It's just building on itself. So I would have been I've been loading up the truck there because now it's doing exactly what you would think. And now all I'm thinking of is 3 stacks of high society for you Rounders fans out there. And how can I get as much into it as possible? Let's go out another week, just acting beautifully. Go out another week. Okay, now it's starting to fall. And let's look at this and see. And I haven't restudied this. I mean, I used to know this the back of my hand, but that's been a couple decades since I've even really gone over this. So this is all fresh in my mind. So breaking the 21 day in a huge way, I'm selling. Now I'm not selling everything because hopefully I still do have some of this cost basis from over here and over here and over here and over here. But what I'm doing is I'm selling on this bad break any of the shares I bought there and there and there and loaded up here. Because again, there's the quick and the dead, and we know that this goes higher, but you can't have that in your mind. You have to pretend like this is all the information you have. Big gap down, highest volume that we've had on the downside going back, really till back over here. And yes, it did close back at the highs, 93% closing range within the bar, but still you have the gap in there. So I'm selling a bunch and I'm trying to sit with stuff over there. Now, if I'm if I'm swing trading it, I'm selling some too here because the RS line is going through your moving average, your short term, but it's not through here, so you're still holding the bulk of it. Let's look and see what the Nasdaq is doing. Not that bad considering, so it must have been specific news to just Apple. Okay, so now we're going to go out another week. Now it's starting to live underneath the 21 day. Your 21 or your RS line is now living underneath that moving average, but not under your 50 day of the RS line. Let's see over here. This is your first signal if you're position trading it to lighten up. So again, this is the Quicksand Grateful Dead. And for this one, we're going to assume that going forward, just to speed this up, that we're going to do this on a weekly and then eventually a monthly basis and stop with the daily, because otherwise this is going to be a 4-hour one. But I highly suggest you guys do this on a daily, staying at home or at home. So this would be a sell signal. Your first sell signal here, since over there. And so you're going to sell some, but you're going to keep the balance. Let's go out to the end of the month here. So you have nice support that week there and it's poked back up. Let's look and see what it looks like on the daily. So whatever happened with his gap down there that made it look negative is even better, this 11% move, this biggest move that it's had, a gap, your low is back above your 21 day, tons of power, your RS line is back up. So let's say you'd blown out your entire position. Now you shouldn't have, because on the weekly it didn't, but you just, you make mistakes in life. I make 51 and a half mistakes a day. on average. So let's say you blew out the whole thing. Now you're just thinking, okay, how can I get back into this in an intelligent fashion, and not knowing what ends up happening afterwards. Was that June? No, it was July 15th. Let's see. So you have this big gap up and you're saying, okay, I was shaken out of it, and let's say that you didn't buy it back on that that outside day upside reversal, which you should have the day before, even if you were still into it, in it, with that shakeout below the 50-day, closing near your highs. Let's just go on that day. Frankly, that was your first good day since over here. Oops, the 25th. Let's go to the 25th. That day looked great. Then the next day looked terrible, right? And if you go bar by bar, they all looked terrible until you got out to this day. This day looks great. Upside reversal. So you would shaken out below the prior lows, close above the high from the prior day, larger spread than the prior day, obviously. Close back above your 50-day. RS line is poking back up. Let's see what the market is doing. Wow. Market's down 0.87. That's why you wanted to play the three-dimensional chess. And Apple is up 1.23. That's huge. Now your next, so you're adding to it there, or even, Bill would always say you can buy, the stock as it comes into the 50-day. So you could have been your initial buy there, and obviously got lucky with that to a certain extent, because there must have been some news for it to pop up like that. I'm sure you guys could Google. Maybe it was a product launch or something, which those used to be a big day, a big deal, like kind of a Fed day, like just sitting watching the Apple thing. And those were just fascinating. So the next day, not doing anything wrong. Let's go out a week or two, is just digesting those gains, staying back above the 50-day. And you would have been buying, I would have been buying more of it here. There was no reason to add to it as it's coming down, but now it's going back up. Then you're saying, okay, as long as it holds above that, which coincides with your 50-day, you're good to go with those ads. Let's go to April 6th. So now you're selling all that. And now this is the fun part. I didn't know that was going to happen. And you have to ask yourself, okay, that it ends up going a lot higher. Like, let's just go out, and I'm going to show you. This goes a lot higher. But we're down here on August 6th, and this is why we do the change date and do it this way. Don't do it over here, because then you're going to make all these BS, hindsight, Monday morning quarterbacking type of excuses to sit with things you wouldn't have sat with unless you have some black and white rules. So don't do it the other way where you change the date, please. If you're going to do that, just stop this. Just stop it. Don't watch any of my videos ever again, because they're going to do more harm than good. You want to go through it and ask yourself, what would you do at that point, at this point, knowing that it never goes lower than that. So let's go back to that point. What was that day? August 6th. So that's here. So what do you know now? Let's see. We started buying it over here, adding and getting shaken out and adding. And now have a serious break of your 50-day, down 5% on the day. You've got a gap in there, 6% closing range, and it's on a Friday. So let's look at it on a weekly chart. What rule is going to keep you in? Well, this is the rule. Your Quicksand Grateful Dead, because, and that's why I developed that. That would have had you selling some of it, here, but then buying it back over in here. So now, and just a refresher on those, the Quicksand Grateful Dead rules are to keep a core part of your position to help you in times like this. And why I developed it, because I know that if I hadn't developed those rules, I would be puking out everything. The entire thing right here would all be gone because of that price action. And that's why I knew that I needed these rules and using a weekly to get it. So again, max position, let's say 25%, our core position, 15%, and that 15% is what you're allocating to this Quicksand Grateful Dead, which will just, to simplify, we're going to say 5% is for quick, another 5 for Quicksand, and the last 5 for the Grateful Dead, meaning you sell 5% if it goes through. Let's just go over here. I'm way over here now. 5% there, over here, because it's broken through it. Now you would have sold your other positions because of what the stock was doing back over here, or maybe what the market was doing. But then you're holding your 15% using this Quicksand Grateful Dead rules. Now it breaks through that on that week, and you're saying, okay, I'm going to sell 5 of that. So now you're down to a 10% position. Then it goes lower here than your original quick. So that becomes a Quicksand. So you sell another 5, and you're holding that last 5 until you get your Grateful Dead signal, which is right there. So that is well off your highs. But let's go back there. 5, 5, 2000. 5, 5, 2000. So that's where you'd be exiting your full position. Now, that's going to suck, because that's way off your highs. But let's go out. Let's just go out 1 year. That's a good sell, right? Go out 2 years. Ends up being a really good sell. So we're coming back to our current chart. And again, let's see, where were we? I should have, what were we July 14th. No. It was the gap. Where was it, guys? Everyone's yelling at me. Yeah, it was August 6th. Okay. How do I remember August 6th? Yeah. Close to the days between for Jerry. But okay. So on this day, how are you holding it? And that's because you would only have your quick. So you would still have 10% of your account at this point because you didn't trigger your Quicksand. So again, why I developed those rules. Now we go out the next week. You just look at that RS line. Did it go below it? No, it didn't. So you're going to hold it. Go out another week. Okay, it's back below it. Now you never added to it. Didn't give you any reason to add. And it's still above. Let's blow this up. Oops. It's still above the low here. So you're still holding on to the 10% because it hasn't gone below that. Now let's go out another week. Now it's poked back up. So again, why I developed those rules, because I know myself. I've done a million of these where I would have puked out the entire thing at the lows there if I didn't have these rules that I believe are not perfect, but they're the best rules for me. So now your RS line is poked back up in a new high ground, and now you're thinking, okay, I need to add to this. So what I would have been doing at this point, having lived through that, on this day where you're back above it, I would have been adding to it. Maybe even on this day, frankly, just being honest. But really just kind of knowing myself and how I was wedgy there, I would have wanted a little bit more, like really poking above something. So I added nibble. So let's say I had 10%, maybe I make it 11%. But this day, I would have added really heavy because it's back up to this prior resistance here. And now it's changed its character. Let's go to the 25th. So you can see, like, even if you had missed it this entire run, no harm, no foul, you could be buying it heavy on this day. And even, again, it wasn't making fun of the guys. If you didn't know what the symbol was over here, there are plenty of stocks I don't know the symbol for, down in here, it's fine because it really hasn't done anything but chopped you around for, this is in May and now we're out to September. So there's nothing wrong with that. So buying it heavy, backing up the truck there. So at that point, I might even, having lived through all that, and I'm at the RS line back at new highs, and it's breaking out of a standard base. You can see this is consolidation because it's 16% deep. If it was 15% deep or less, we would have called it a flat base, but 16% deep base, and it's a base on base. So how you read that is this was your 1A. You see it there under stage. 1A1, meaning it was your ends up having multiple bases, but they're base on bases. Then you have a 1B and a 2, meaning it's the second one. You have number 1, number 2. And that's because from this point here, the 2958 to this breakout there was not more than 20%. If it was, that would be another stage. So from like here to here, it's probably 20%. So then that would have been a second stage. So base on base, base on base, base on base. So that's very normal and can be very powerful. So I'm just loading up the truck, and the only question I've got to myself, am I maxing out at this point, or am I just doing, probably 20%, most likely? So those are the questions I'm asking myself. I'm learning from these as well, because I don't remember what happens. Maybe it blows apart the next week. I already forgot what happened. Okay, so now it's just inching higher. Let's go out to the end of the month. It's just inching up each, and notice, 1, 2, 3, 4, 5, 6 weeks up in a row. One of the things that we studied, that 5 weeks in a row, more consecutive weeks, is a very positive sign, and we interpret that as institutions are building a position, and they can happen a lot longer than you think. Okay, let's go out, speed this up. Let's go out another month. Okay, now it's really accelerated. Let's look at it on a daily, see if there's any other places. So, it's been holding your 21 day, probably gunning it here. I know it seems like, frankly, I would have been gunning it here, and I would have been gunning it here. But here, as it found support and I would have been gunning it here. So I know I'm at my max position, because there's a million places on here where I would add. So ask yourself, where would you add? And then really be gunning it there on that gap up. I mean, I might make an exception to my max position there. Now I will say, well, let's go out a little further. Let's go back to the weekly. And that RS line is acting beautifully. And look, it hasn't given you any sell signals way above that. Now, at some point, if you're up enough, you can convert over from your weekly to your monthly and use the moving averages there. And I haven't come up with an exact amount of percent or time before you switch over to the monthly, but I think it's probably somewhere in the 100% move or more. So let's say, it's a 23 breakout, and then so 46, so maybe move over to the monthly, but I'm not sure. You can always split the difference and do some weekly, some monthly, but we'll circle back to that. So it's really accelerating at this point. And I'll tell you, at the firm, stop share for a second, this was a scary time, because this is the first time that I think I went all in. And so all of the guys and girls around Bill, everyone wanted to be Bill. Myself, probably more than anybody, I wanted to be Bill. And I don't want to be Bill anymore, because I'm not Bill. And it took me a long time to realize that. That was a big deal, figuring that one out. And but this is back when I wanted to be Bill. And how you become Bill is you have these stories like, oh, he plowed 200% long into Syntax, 200% long into Amgen, 200% long, 200% meaning you've got an account, let's say it's a $10,000 account, or let's just say a $100,000 account. So that means you've got $200,000 worth of buying power, $100,000 of that on margin alone. Most people should not go on margin unless you've been trading for a long time and you understand the dangers with it, huge dangers, huge reward, huge dangers. So he would go 200% long, Syntax, Pick and Save, Price Company, which think Costco, Amgen, ultimately eBay, and a lot of other times, AOL and Schwab. He was, Qualcomm. So he has this history of being able to do it and really capitalize on it. So we all tried to do that. And during that time frame, we all loaded up on Apple and Google. And frankly, in my firm account, from memory, it was about 120% in Apple. It's stressing me out just thinking about it, and 80% in Google. And some of the other guys would be, you know, we never didn't really talk, but you kind of hear it through the grapevine. Everyone else was pretty much that way, either like 120% in Google and 80% in Apple. But we were all pretty much concentrated into it during that time frame, and we got away with it. We made a lot of money, but we didn't have to, and it could have blown up. I went to bed every night during that time frame, paranoid that Steve Jobs was going to die in a plane crash. I don't know why, but I worried. I didn't worry about the Google guys, maybe because it was only 80% of the account, but there wasn't this one person associated with Google the way, the guys were kind of, and then they brought in whatever, Eric Schmidt or whoever he was, and it kind of, watered things down a bit, but Apple was Steve Jobs, period. I mean, Steve Jobs was the only one who could come up with this, and a team around him, but you could tell it was him. But so anyways, I was just paranoid that was going to happen, and that IBD and William O'Neill and Company were going to not exist anymore, nor my own account, because I was loaded up, and I typically mirrored what I did in the firm account and my own account, sometimes even more aggressively. So that's a warning. Don't do that, unless that's something that you feel really confident in doing. And I'm not saying that I haven't done it since, but I never trade well when I'm doing it that way. And after this, I studied that time frame, and I that's where the 25% came from. Is that anything more than 25% is really ego. In my opinion, because 25% is crazy in one stock. But think about it, 25%, and the stock goes down to zero. Okay, you've lost 25% of your account. That's going to hurt, and it's going to take a long time to come back from. You're 200% long a stock, and it goes down. Do the math. You're wiped out. You are wiped out. So you don't want to put yourself in a position to be wiped out, and that's what long-term capital. The guys over there, if you don't know about long-term capital, Google it. The smartest people in the world, always do these concentrated bets that that blow them up, and so that's for the longest time I kept on trying to do that, and I could never handle it right because, well, let me share, and I'll kind of walk through how so let's say you're 100% in a stock like this, and it's coming down normally, let's say 10 on 10/12. Oops, wait, no, 10/12. Okay, so the day before Sammy Hagar's birthday. So let's go to Sammy's birthday. So gap up, so that's a good day. So down here, it's coming down to the 21 day. It looks normal and natural, and you're looking at this and you're watching it on the weekends or whatever, and going, yeah, that looks perfect. It comes down nicely. But, let's look at it on a weekly. Well, it reverses by the end of the week, but you're down quite a bit off your highs, and if you're 100 or 20% or 200% long this name, that is going to impact how you think, and you're not going to make the smart decisions. I know I didn't. I would constantly be reducing into weakness, and then on this day I'd be buying that back, and that really hurts you. Performance-wise. Now, Bill was, because Bill was Bill, and the only Bill around that ever will be, and no one else was even close to him. I saw a lot of people try to be him, and never seen anyone remotely get close to him, that in being able to hold a position, because he would use his cushion, his distance from his cost basis to where the stock was, and say, okay, as long as I had an X, he would do it in points, but let's do it in percent. Like, let's say 30% cushion. He knew that they couldn't take that away from him overnight, because back in the day you didn't really have 30% gap downs. Now you have them all the time because Reg FD, we've talked about that before. We'll talk about it again in another one, but you get these gap downs on earnings that you didn't get back in the day. And so he would say, okay, I've got a 30% cushion. They can't take that away from me. So he would just sell down, and he would sell. He didn't do LIFO or FIFO or average cost, different accounting methods. He would do highest cost first. So he would instruct the accounting department to say anything that he would have bought up here or up here, that down here he would want to be selling those shares. So highest cost first gets sold rather than using your average cost. So he would always be worried about his cushion, and he'd really want his cushion down here. So he would know ahead of time, where is that breaking point, and could he survive that or not? And that's the difference from Bill to everyone else, and include, especially me. What I would do and still do is I ramp up my position size too quickly. And it's been a recurring theme, and it all happened from Google, in fact, and I'll show you why, and I'll tell you, wasn't that long after this. Let's go out to the Google. It was right in, the next space. It was right in here. So someone remind me on 420.05, so right over here, that this is the first time that I broke a rule. And I'll just tell you now that, so we were in Google during this time frame, as I was talking about, and we were in it heavy, and I'll do another one talking about the IPO base that I invented after we bought this out of what Bill and the guys would call a high tide flag, which was not a high tide flag. And so I did a whole study work and came up with the IPO base, and I'll do that for another video. But over here, we had been out of it because we were in it during this time frame, and then when this base breakout failed, we removed it from the list somewhere in there and took it off. And I remember telling them down here, I'm like, it's tightening up, and we've got a 48-hour window. Why don't we put it on now? Looks like it's rounding out. And boy, he beat me up, and he's like, no, this is, all these things are wrong with it. I'm like, okay. And then fast forward to, maybe it was over the weekend. No. Yeah, it was before that. So it would have been, no, yeah, I was right. So it was on this day. No, yeah, it was the 19th. I'm sorry. It's been a long time. I haven't looked at this since in 20 years. Another PM called him up and said to put it back on. And now that it was back above the 50-day, he was fine. And so I think we had 48 hours or what have you to buy this. And during that time frame, what we had is these rules at the firm. So the first two fund managers to PMs to buy, I think it was like 25,000 shares or something like that, would control the stock, and you would have 1 day to buy it. So let's say we put it on our NESME list this day, and then 48 hours later we can buy it. So we'd have one day to buy it unless you controlled it. And my account size wasn't big enough to control it. And I knew that, and I knew that I was going to be blocked from it because it was such a quality name, that I used to be methodical, and I would never put more than 15% into my account, 15 into my account on any given day. And that was a hard rule. Like I wouldn't, like that was a big deal for me. But I made this one exception, and I said, I'm only going to have 1 day to buy this. And I put my chips in, and I went 50% in on Google on that day in the account. And sure enough, even with that 50% position, the next day I was blocked. And so I couldn't trade it the rest of the rest of the move. Maybe that's why I kept the 80% instead of the 120. And so during this whole move, I couldn't add to it. And so it reinforced this negative thing that, if you put in 50% of your account into it and it makes this monster move, and I'll reiterate this when I do the video on Google, but that it reinforces this negative, this thing that you shouldn't have done. From a risk standpoint, I never should have put 50% of my account in there. And this is all from memory. So if I'm off by a little bit, I'm off by a little bit, but this is how I remember it. And, so I'm making all this money, but I can't add to it and I can't subtract it either, because if I sell any, when I sell a share, I can't buy it back. So then that created this other risk. The only one that I could control was Apple during that time frame. So that made it very tricky. But let's go back to where we were in with Apple. Let's see, where were we? Go out to that weekly. Sorry, I got off on that tangent, but because we were talking about midway through in here. So let's go back to October. Oh yeah, we were around Sammy's birthday. So during this time frame, being so heavy, let's say it was 120% in it or so, I would make silly mistakes selling it down and then just having to buy it back. And that was a huge mistake. So if I would have just been 25% into it, I would have said, okay, this is legitimate, normal pullback to the 21 day, no harm, no foul. And then on this day, I wouldn't have been able to add to it. I would have sat with that and would have done a lot better than doing the ego thing of having this big position. Now, I say 25% because that's for me. Now for you, your max position might be 7.5%. That might be a monster position for you. So adjust this. Maybe for you, it's some other of you, it's 33% or 50%. Just have a number. So now we're going into this real big run, and this is why you want to keep those moving averages on here to just keep you in this run. And let's just fast forward this a lot now because it's running. And okay, 3 weeks tight in here. So this is really like in the spirit of a high tide flag. So you've run up a large amount in a short period of time. So really from, let's call it 32-ish up to 55-ish, not a double, but close to it in that spirit, and then breaks from there. So that's where you're going to really gun it. And even if you started gunning it here and selling some, you're buying those shares back and more on this day. At least that's what I would be doing, because you have to ask yourself what would be abnormal and what at that point, and what would be abnormal would be a break like this if that happened right away. And if so, then you would exit those shares plus any of the shares that you bought in here and might sell everything but your core. So you're looking for these clues of where can you really gun it. And look how nice that was here, this upside reversal in here. Probably around, I'm guessing, a product announcement. You probably Google that and see. So runs up, holds in tight. It's just holding the 21 day. Let's go out another month. Kind of getting a little sloppy in here. This would have been difficult, certainly on this day, on January 11th. Just be honest with yourself. That would have been very difficult. So anything that I would have bought on this day would have puked out over here. But then you're trying to hold your original cost basis because, look, your RS line is smoking. It's way up here. It's not doing anything wrong. On there, it's above everything. Looks good. So now let's go forward to the end of that month. So anything that you would have sold down there, you could have certainly bought back. Up here, you didn't know that it was going to close terribly. But keep in mind, even though that's a bad close, let's go to that. January 13th. Okay, so just picture that this is a blue bar going from here and it closes there. That's really not as bad as what that looks like, that gap up closing at the low. So in your mind, when you see those, just go, okay, fill in that gap with a little blue bar and it's not as spooky. It's running up a little bit of a wedge there. Not really. What I mean by wedge is it's not shaking out below the lows of your prior day, which, between that, and that, it's a little bit worrisome, but there's nothing wrong with your RS line is smoking. So let's look over there now. It's accelerating. Let's see what the market is doing at this time. Ooh, the market is really running into trouble. So the market was running into trouble here. What is that? January 3rd. So let's go back to Apple. January 3rd. Wow, so it really bucked the trend of what was going on in the market at the time. That's pretty impressive. Okay, so now we're going out to the end of March. Okay, now we're starting to break a little bit. This is a little bit abnormal, right? Because you're coming up here, and notice why I say it's abnormal is look at the distance between your 21-day and where it's trading. It tends to live above it, live above it. Now it's breaking below it, which at that point is telling you it's probably going to base build, which is what it ended up doing. 15% deep base at that point, and found support at your 21-day or at your 50-day. So nothing wrong with that, because stocks need to base, and it's actually healthy to base in there. And these are kind of like a little Darvis box. If you've never read Nicholas Darvis, How I Made $2 Million in the Stock Market, it's such a perfect book and such a simple book. Everyone should read it. One of my favorites. If you've read it, you know what I'm talking about with those boxes. So let's go out a bit. Okay, so it's formed this base, and now we know that it breaks down from it, but let's be intellectually honest and go back through here. So on 4-4, that looks good. Looks really good because your base building, it's only 15% deep. It's your fifth base in there, third stage base. And it closes back above your 50-day. So that looks fine. Let's go out another day. I'd be adding to the stock there. Why wouldn't you? You know, if you wouldn't, then you have a rule around that, and there's nothing wrong with that. That's a little weak, but that's fine. That's a little weak action. Notice how we've had a couple things of kind of a change in character. One, that was a bit of a change in character. This kind of wedge over there, rather than having power, was a little bit of a change in character. In this day here, as you're going over a marked high, you should have it more power. Like, look at this marked high, the 33.75, and when it went through it, it had a ton of power. Now it shook out after that, but still it had power. So little subtle things. But your RS line is still hanging in there. Let's look at it on a weekly. Oh, that shows the end of the week. But we're being honest with ourselves. Okay, so now that RS line is back through there. But still, it's not doing enough wrong. It's down 4% on the day. It still just looks like it's base building. Let's go out another day. It's firming up. Now, it's a real break of your 50-day. Your first time that you broke the 50-day and closed below it this entire run. So that's, now you're starting to get signals that are starting to pile up. So one thing that you can do is use the marked up tool, or the markup tools in here. And let me go here. And let's see, you could, with little red mark, let me refresh this. You could be marking on your chart little things like that. Red, do another one, pointing red, but also red for anything negative, and change the color over here to green for any of the positive things. So that's, oops, I think you get my point. That doesn't want to, come on. Okay. So it did it over there. So anyways, you can have that on, and then let me just delete those. Here, let's just turn those things off. We need to do a better job with our marked up tools, frankly. But with this, if then you're looking at it, not looking at it all the time, but you're always marking it up with green and red, or choose your color if it's kind of a touch of gray in there, that then you look at it, and you, rather than falling in love with the stock, you can just look at the reality. Are you starting to see a bunch of negative things in there? And there are, and that is probably the biggest plus this. You can tell that there's selling going on there, but it's just base building, and it hasn't undercut this low. So that 40 is really kind of your more important point. Um, so the RS line isn't doing anything wrong. Now this is where you've got to sell a bunch of it, right? Because we've had those things that added up. You maybe done some selling there, but even if you held off this day, now you get a gap, and you don't have to wait until the close. You get a gap down below this area with all the other things, and you're selling. Now the question then just becomes, how much do you sell? And that's where I would use my Quicksand Grateful Dead rules. So this is on a Thursday. Let's just go out to the Friday. So really bad, right? But let's look at what's going on in the market. So the market is falling apart. So the market had been falling apart over here, and eventually, as Bill would say, when they raid the house, they get them all. There's no sacred cows. He had a ton of lines like that he would always say. So when the Nasdaq or the S&P can't hold above its 200-day, kind of all bets are off. Like when that happens, and just study it historically, you kind of have to switch gears. But that's a topic more for the three-dimensional chess part of it. And I don't want to make this too confusing, but really holding something when the market is underneath the 200-day is kind of a no-no, because it'll make it very, very difficult. I'm not saying that you can't, but it's just the reality of there's so many pressures coming at you that it's not likely that it's going to be an easy ride. Now, it doesn't mean you don't hold some, but you wouldn't hold your massive position. So let's go to the weekly and see if it's triggered any of our sell rules. So it triggered all of them. So let's go through it. So earlier in the week, you went through your quick because your RS line went through your moving average here. Then it went lower than that. So then you would have sold more because of the quicksand when you go lower than your break of it. And then by Friday, you've got to sell the whole thing, because now that's your Grateful Dead signal. Now, we know that this goes a lot higher, but you just look at it and you just say you've just got to sell it if those are your rules. Now, you might have some rules saying that your cost basis is, let's call it, because it's split adjusted now, let's call it $16, that you're still a double from there, and that you're going to hold it until whatever. You have your own rules. If you have your own rules that you've back tested and work for you, great. But these are mine. I'm just sharing them with you. Really shouldn't share them, but I'm a believer in karma. That's why I'm, a large part of why I'm doing this is positive karma for myself, but really for my family, and we could all use it. So now going through this, you're looking at this and just saying, okay, you're not going to buy the stock back until your RS line is back above those moving averages. And so I would use whatever one you were using for your trade. So if we were using a weekly, then we're going to use weeklies. Let's see how that monthly panned out. So if you're using the monthly on there, you didn't sell it because it hasn't even gone through that. So those of you who look at this and go, this is just too much for me, too much trading, you can go to the monthly and say, okay, I'm going to just use that, and you'll see the advantages and disadvantages. So let's go out a month. It's, so it poked above there for just a little bit, but it didn't give you any signals on the daily. Let's go over to the daily. So at this point, that RS line had poked up above it. Let's go just to the highs on 526. And being intellectually honest, I would not buy this here. And if I did, I shouldn't have, because you've got a base underneath the base. Even though Pattern Rec is picking this up as one consolidation, really, you've got a base here, and then now you have a new base that's formed here. You want a base on base. You don't want a base under a base. So you either want a really smoking RS line, or you want it trading up and around here or higher before you're buying it back. So let's go out to the weekly. I know this is long, but it's free. So, what are you going to do? And you can fast forward. So RS line is living underneath here. So this will keep you from the chop, you know. Again, I'm saying all these things to myself because I have a few stocks that I just love and I keep going back more than I should. And, doing this helps me as well. Okay, so now your RS line has been back above it since the week of July 15th. So let's go to the week of July 15th. So it's back above it. And so let's look and see if there's anything on the daily that we can do. Okay, so now we've got a gap up. You know, that would be a hard buy. Frankly, that would be a hard buy. But the market has firmed up quite a bit. And this was one of our favorite stocks. So it kind of gives you a reason, but you're not buying it with any size there because that's not really, that's not ideal. Let's go out a week. It's building on itself, but still, you could have bought some here, added to it here. It hasn't really given you any other entries. Now it's a little running into some problems there. That's not ideal. Finding support at its 21 day. So these are the things that you would mark with your a blue mark in there, or a blue or green mark, because you had your downside reversal here, which should have pushed the stock back down to 40 and didn't. And that's very significant, and it firmed up right at its 21 day, which, remember, in the past, on its way up, it really held the 21 day nicely. So let's go out another week. Okay, so this is your first real entry point. Let's see, on August 9th. So that's your good entry point. You can even say from over here, you can draw a line there. It hasn't quite reached that, but if you drew a line here, which I would exclude that peak there, and that's a topic for another day, I'd be buying some. And look at how that volume picks up nicely there. Your highest volume in a couple weeks. Wish I trusted volume. I trusted it back then. Now on this day, big pickup on volume on a Friday, and clear breakout. You're hitting that thing hard. Let's look at it the weekly, and you can see in here, what do you have on there? A cup with handle, or a cup without handle of your RS line, and some tight action there. So you're hitting that hard. So even if you had sold it all that week and you didn't buy it back over here, didn't buy it back over here, which is totally legitimate, this is where you're buying it back, and buying it back in a big way. Let's go out a week. It's pulling back, normal and natural. Never fun, but still normal and natural. Go out another week. Okay, so it starts picking back up. So this is the week I would have been adding to it. Really nothing to do in there, frankly. That looks like, yeah, I'd add to it on this day. Let's go out. Yeah, add to it. Now again, you're paying attention to the character, and it's finding support at its 21 day, again, acting nicely. Not a reason to have your max position in it yet, but let's just see how this pans out. Well, you still have a decent position. Okay, it comes down, and this is your first test of your 10-week line or your 50-day, and it does it in a really nice, healthy way. Let's see, on 10-12. So it pulls back in, gets support, 57% closing range, right at your 50-day. Let's see what the weekly looks like. Nice support there. This is by the end of the week. Let's see. That's what it looks like at the end of the week. Let's look at it on a daily at the end of the week. So nice snapback. If I would have sold any in here, which I would have sold any that I had gotten carried away with, maybe any of those ads, then I'm buying those back on this day, and potentially at lower prices, actually, because of that power and support that it's getting off of the 50-day. What are you doing? You should be asking yourself that on every one of these. What are you doing? Doesn't matter what I'm doing. I'm just walking you through my thought process to help give you an idea of how one person trades and how I trade right now in 2025. If I would have done the same thing 5 years ago, I would have different rules, or 5 years before that, or back when I was trading this traded it differently. So now let's go out to the end of the month. It's getting a little choppy. Let's go to the end of this month. Choppy, but here you could add here, you could add there, you could add there, holding above the 21 day. But it's, let's go back a couple weeks. When it's compressed, it looks a lot better. Over here, that's choppy action. But now when you go out further, it just looks nice and tight. That's why you do the change date, and at home you should do this on every one. And I know I've been going so long that we need to speed this puppy up. So here is kind of your first changing character. On the 14th of December, you get a gap down, big pickup in volume, down 4%. Yes, it's finds support at its 21 day. Let's see what the market was doing. Market was holding in there tight. What was Google doing? Google was fine. So stock specific news most likely. So now at this point you're thinking, oh, maybe it's going to do a high type flag-ish type of thing and form something around there. But if you've gotten carried away, if I had added any there or added any there or added any there, I'd go ahead and sell those shares here. Because just knowing myself, I would have been adding at those points. And now that you have your first sell signal, I'm going to, just back away from those. Not too bad. Go out a couple weeks. Shake out below. Actually looks much better now. Let's go out a week. Looks a lot better. So on this day, that's where you could have been buying some back. So anything that I would have sold on this day, that's where you could have been buying some and actually adding to it over here. I don't think I would have bought any on that upside reversal at the 21 day because it still looked like it could have come into the 50 day, frankly. Just got to be intellectually honest. Okay, now it's really moving out of there. So again, we've added there. After a shakeout like this, and this is really like a high type flag-ish type of formation, that looks really good. Now, I know what Bill would say is if this doesn't work out, this is too short for a base because you got 1, 2, 3, you could say 4 weeks, but he did come up with a square box. It is 4 weeks. But let's just go through this. And everything is looking good. Now it's not. So now you get a failure in the new highs out of a tight consolidation, high tight flag. This is abnormal action. Let's just walk through where it becomes abnormal. Let's start on this day. Totally normal. Totally normal. Still normal. Abnormal. Okay. When you're pulling back in along the way, what'll tend to happen is you'll have 2 days down and then an upside reversal, 2 days down and an upside reversal at the most. So like even over here, 2 days down, upside reversal. Upside reversal doesn't mean that it's always blue. 1 day down, 2 days down, and then up. 2 days down, and then up. 2 days down, up, and so on. Let's see, 2 days down and up. 2 days down and up. Over here, this is where we start running into trouble. 2 days down, and then you get weaker, and that's what was problematic. So now, 2 days down, and your spread widens, and this is important. Only down 1% here, down more here, 2.6%. Now it's accelerating. Big deal. Just like quarterly earnings and sales, acceleration is a big deal. Accelerating on the way down is a big deal. That means that there aren't buyers around. And yes, it's still above the 21 day, but that's a reason to back away from a lot of your shares. Certainly, any of the shares that you would have bought here or here, because this looks like it might be a failure down to your 50 day. In a rule that I'll talk about in another video of breaking out of what I call a nothing, I'll still buy, but when they come back in, then you sell and you sell heavily. So let's go to the 20th. Okay, so now even more. So down 3.73, A little bit less than the prior day, right? 4.1, but still about the same and closing at the lows. And it did try to move higher, at least intraday, closing back below this. So you're out of everything that you can be out of besides your core. And that is not giving you a sell signal yet. So, you know, that's a bit problematic because on the weekly, it looks terrible. On the daily, it looks terrible. But if you're using a rule, you're using a rule. And so I'm going to just sell down, you know, if I'd had a 25% position in it, you know, by this point, I'm probably just down to my core 15% because I know it's in trouble. Let's go out a week. Okay, just more selling. And you can kind of see that and go back and do a change date to each one of these and really interpret it with an open mind. Let's see what the RS line is doing. Okay, so now we got a quick and quicksand, it looks like, because it went through it on that bar and went lower there. So so on this, there, it was strange because when we did that change date, it wasn't there. I hate when it does this, you know. Visually, from when you do it through those lines and you have more space here, you see a cross that doesn't happen. So regardless, that's either a sell of one or a sell of two, a quick and a quicksand, or at least a quick. And let's go out a week. And so it goes fine there. So let's just call it as a quick and a quicksand. So now you're down to 5% and you're waiting to see if this RS line can hold above this or not. Well, let's see if it does. I don't remember. Okay, it doesn't. So now you're back out of it completely. That last 5%, you're out of it. And pretty sure I remember that. Well, I'm not going to tell that story. That's going to take even longer. So now you're out of it. Let's see when we get back in. RS line is still below those moving averages, so we're out of it. Staying out. Let's go out a month. RS line is even lower. We're not doing anything. Go out another month. RS line is poking back above it, but it's not really giving you a clean entry. Let's look on the daily. No, still looks weak. Go out another month. Okay, the RS line is back there. So again, remember, we've sold a lot of it this week. I mean, refresh this. A lot of it on this week. Sold more of it here, sold more of it here, and we sold the rest of it here. Now let's go out another month. So you're not, more importantly, you're not in this chop and you're not buying it back and buying and selling, because that RS line is underneath those moving averages. Now it's back above it. Now I know when Bill would do this, he would call this a shakeout +3. So let's go through that. So this is, you can look at it as a double bottom. And double bottom, that would be your pivot, the high of right there. But there's the Livermore shakeout +3 that we went over during the Cisco one, that you would take this low here, 57.67. Let's look at it on a daily, because you'll see that marked low there. And we're going to just take our little calculator. Don't think the calculator is showing up on there, but 57.67 times 1.05, so that's 5%. So that would put you at 60.55. So right around here, that would be the first day that you could buy it. So shakeout +3 is $3 on a $30 to $60 stock, so that translates to 5 to 10%. So 5% would be there. That would be your first entry, possible entry, and your second one, 57.67 times 1.1, 63.43. So where is that? 63.43. So on this day. So more realistically, because you're underneath your 50-day, you're underneath your 21-day, 726. That would be more likely where you would be buying and not the over here, because look, that RS line is in a decline, and this is a bit hindsight BS, frankly, because buying something underneath the 200-day in this position, it really has to be Apple or Google or a company that you really, really, really know backwards and forwards. And typically you're buying it because the market had some problems. Let's go over to the NASDAQ. So look, in that context, it looks so much better because the NASDAQ was falling apart and, Apple wasn't, let's see, on this day, 720. Let's just go there. And on that first day up, and let's see what the market was doing at that point, see if it was leading it. So the market was still down on that day, down 2% on that day, and Apple is up. And that's a positive divergence and a huge positive divergence. And that is a big deal. So I take back what I said about being underneath the 200 day, because this being a quality stock and in a kind of a bear or major intermediate correction, that you do make these exceptions. But normally, let's say you're still in a bull market and you're near new highs, you're not going to be buying a stock underneath the 200 day. Like it's so rare. I mean, it's so rare. Okay. So anyways, but that could be where, and let's just go forward a month to see where your kind of more traditional ones would be. It's nothing wrong with not buying it there. Now it's kind of firming up because you can see the double bottom that pattern rec picks up, and it's really a double bottom with an early handle, which you could say right there, if it breaks through that you could be buying it. And that's more of your traditional one. And it's finding support at its 200 day. That's very key. Let's go out a month. Okay, so yeah, so right there, 9.5. So this is really your real buy point. I know the shakeout plus 3, getting in here gives you a little bit of an earlier entry, but honestly, buying it there, I would have been shaken out over here or here, or even here, intraday at the lows, or here. Like, come on, be honest with yourself. You're buying something there. Are you really still sitting with it there? No, probably not. But everything looks great now. RS line's poking back up near recent highs. Big pickup in volume right after a 3-day weekend. First one to go out of there. Let's see what the Nasdaq's doing. Nasdaq is moving higher. You had a follow 3-day down there. Let's go back to Apple. So that looks good. Boy, oh boy, I thought this was going to be 30 minutes. I don't do a good job with time management, do I, kids? Okay, so, or grandkids, whoever is watching. So with this one, now you've got your double bottom breakout that happened right there on the weekly. RS line has been trending back above the moving averages. Let's just go out a month at a time. I think you're kind of getting the sense. It's a little bit slower. We'll go out another month. It's still slower. Let's toggle over to the daily. Trending nicely, finding support at your 21 day. All looks good. Your RS line is not triggering any sell signals. Let's look at the monthly now. How did the monthly work on that? So during that correction, you would add your quick and your quicksand. So if you would toggle it over to your monthly for those signals, you would have sat through part of that, your 5% of your position, because it never even got close to down there. So that's the upside to it. But then again, how would that have felt on this day, 7:14? I know I said I was going to speed up, but come on. No one believed me. I didn't believe me. So on that week, you're still sitting through that because it's above it. That's not easy to do. I couldn't do that. Like, I know myself. So let's go back out to November. It's just trading nicely, 2 weeks tight. Nothing to see here. Support, and you see how you got a quicksand, so you're selling some, but you don't get your Grateful Dead because it bounces there. Let's just go out a little further. You would get lots of signals on your daily, but here, actually, let's go back to this one. Maybe it did trigger it to the 22nd. No, it doesn't look like it. Doesn't look like it got there. So no, it didn't trigger it there. Let's go out to over here, but it did trigger it on this week on the 2nd. So by this point, so again, quicksand. So now you're down to 5%, not buying anything back until it's over here. So definitely buying back on this week. I mean, look how powerful that is. Come on, you're buying it. I'm buying it. Your mother's buying it. So is your grandma. And but then it fails, and then you get your quicksand, and now you get your Grateful Dead signal. So now you're back out of it. So we were out of it. We bought back in really over here in a big way, and we were shaken out of some of it, bought it back, and now we're out of the whole thing. So let's see how the rest of this month plays out. Not really giving you any buy signals. Yeah, it's back above there, but let's look at the daily. It's kind of, now it's getting a little sloppy in here. You get this gap down over here, get this what I call an iceberg in the middle of the base here where it pokes up and then comes back down. I'm not really a fan of that. I think it works out from memory, but still, intellectually honest, yeah, it works out, but I just don't like that base. Now, over here, it does look a bit better, but yeah, I'm not going to be buying it in here. It just doesn't look right. But now you have the context of a cup with handle on there and breaking out, and the RS line is back there, so that's fine. Let's go out another month. It's fine, holding the 21 day, acting normally. All is good. All is good. Nothing to see there. Out to the end of July. Nothing to see there. Now on the price action is coming back into the 10-week line, but look at that RS line, how far above it is above those moving averages. And so you can see if you're just swing trading it, you're out of it. I mean, remember what we talked about, 2 days down and then up. That's normal. 2 days down and then acceleration to the downside. If you're swing trading at all, or even, early position trading, you're out of there. But here, if you're more in it for a longer term, and you're using these RS line moving averages, you're still in it. Let's go out further. That does not look good on the daily, but it comes back. Now, during this base, this is actually a good week there, closing 59% closing range. So 40% is our threshold on a pink week or a red week, down week, where it's actually constructive, especially with the volume picking up. So that's actually a support week. So you got 3 weeks up in a row, or 3 weeks there in a row that are constructive. But the reality is we would have sold some with our quicksand. So we would have been down to a 5% position at most, but now our RS line is back above our moving average. So I think you're getting that whole procedure. Yes, I know this is dragging on. Okay, we'll go out a month. So you're adding back to it. That week there is a bit problematic. September 7th. Looks better on a daily, but on a weekly, that doesn't look too good. Nice breakout there. That's looking good. Let's go out to the end of October. Wow, really powerful move. That looks good. Let's go out a month. Okay, now the funny thing is the market really collapsed here, and I just remember that because that time frame is etched in my memory. Let's go here, what the NASDAQ is doing. And this was the top of the market. This was an expectation breaker, something that Charles Harris, Justin, and I coined November 1st, and that's a topic for another day, but coined that an expectation breaker, and that's where that, if you ever hear expectation breaker out there, the lingo out there these days, that's where it came from November 1st of 2007. That's the model for that. So on that day, let's look at it there. So your expectation the day before 1031, you go home thinking we're off to the races, and then you come in the next day and you get this. Well, that broke your expectations. That's an expectation breaker. That's where you really want to get very conservative. And I'll tell you, my worst trading day of my career was this day because I was in Crocs with up to my eyeballs in stock, and that happened. And so I'll do a topic on that one. That's a lot to learn from that story. But going back to Apple over here, and let's go out to the end of this month. So the market was coming in heavy, and that's why Apple comes in heavy here. But really is kind of bucking the trend of the market. Even though the market's falling apart, it's staying above that. So if you're using those rules, you're still with it. You're not sitting there saying, okay, we go into one of the worst bear markets since 1929 at the beginning of November, that we're going to sell all stocks. And you don't use that hindsight BS. Don't use it. Don't watch these videos if you're going to do the hindsight BS, because I will block you. Well, I can't really block you, but I would if I could, for your own good, because it does you no good to say you're going to sell here. It does no good unless you have a solid rule to say you're going to sell there or going to sell there, unless that's a same rule that you're going to apply the whole time and that you're not cherry picking. Nothing pisses me off more than that. So with this one, you're sitting there going, okay, bounces off the 10-week line, looks good. RS line is looking great, so let's go out a month, even though we know we're in one of the worst bear markets ever. Now it keeps going higher. It's not triggering those. Now you can sell down to your core if you want to because of the market. Let's look at what the market's doing. Market's terrible. Terrible, during that time frame, really choppy. But let's look at Apple. RS line is still above its short-term moving average. Let's go and see where it crosses. Okay, finally crosses on January 11th. Okay, so at this point, Quicksand. So you're selling 5 to 10%, depending on if that really is a quick and a quicksand or just a quick. Let's go out a week. Regardless, let's just say it's the worst. Well, no, let's just do this accurately. On the 4th, it hadn't crossed through there. On the 11th, it crossed through, so that's our quick. On the 18th, it went lower than the week before the 11th, so that's our quicksand. The RS line is lower. Then here, let's blow this up. Make sure that you can see that, because this is very important. You see that it's through it and goes lower. Quicksand. Go back out. Zoom out. Now we'll go out one more week. Your Grateful Dead signal. It's through. Oh wait, let's go out to the 18th. Huh. I hate when it jumps like that. Oh, because it's gone down so far. So then you're selling the balance of it that week. So you've held 5%. And then we'll do another one of these on, like, do you sell some of it on Monday, some of it, or hold all of it till Friday? That's a big topic, and we'll go over that in a different video because we've already been going a long time. I know I'm going to get hate for that, but I'm sorry. My better half is being nice. She hasn't knocked on the door once to say we were supposed to go out to eat a long time ago. So that was that one. Let's just go out to 09. Here's the bottom of the market. And this one actually held up relatively well. Maybe we'll do another one because we were buying it at the firm back over here, and we'll kind of go over how we did that. And let's look at the NASDAQ during that time frame. Look at that. That was bad. That was really bad. Let's look at it on a daily. I mean, that was horrible. Really, let's zoom out. I mean, this was our expectation breaker right up there. And this was a terrible, terrible bear market. I'm going to stop share. Let me see. Stop share. So if you're still with me, time to hit repeat because you're not asleep yet. So go ahead and put it on repeat. I hope you guys get something out of this, man. I'm getting a lot out of these, frankly, because I just learned a ton through there. And what did I learn? I learned to really trust this signal, to also the Quicksand Grateful Dead signal. Trust it on the way back in too, which will help me because I get some pet stocks just like everyone else. They're my favorite stocks, and I'll go back in and try every which way to figure out a way to get into the stock that really I probably shouldn't. And so using the RS line with its moving averages and making sure the RS line is back above its moving averages before I buy into it, really trusting it on the way out to hold, to curb my enthusiasm. And also as a reminder, the 25% max rule, max percent of my account. And just to be clear, so let's say you have a $100,000 account, that means no more than 25% in there. You're not, but you could go 200% long, meaning 200% or 200,000 invested, or if it's a million, 2 million, it's 10 million, 20 million, and all, you know what I'm saying? If it's $10, $20, whatever. And I'll tell a story maybe next time about my first trade. And it was with, in 1995 with Robert Mondavi. And it took me 6 months to scrounge up $540 for that trade. So trust me, I know, and that's why I'm giving this stuff away for free, where I could be charging a ton for it, frankly. I just know I could. And but I remember what it was like to, go to Taco Bell and, get the 69-cent burritos, or maybe they were even cheaper back then. And I wouldn't even go to Baja Fresh because those were like $3.59. I was like, why am I going to buy a $3.59 burrito when I can go to Taco Bell for 69 cents, or Amici's Pizza, which on like Tuesday nights were $3.33 for a large pizza. Like I remember that like it was like it was yesterday. And so I'm doing these to help you guys out, and I'm doing these, and hopefully one day, my kids and grandkids, know what daddy did. So with all that said, the thing that I do request out of all of you guys is to, do something nice for a stranger, pay it forward, and hopefully you got something out of this, even if you have to break this up into, watch 30 minutes at a time, that's fine. And, send me something on Twitter. Let me know what subjects you want to do in the future. Twitter handle is Webster 1971, and of course, if you're watching this on YouTube, I'm at Webby 5150, and subscribe and all that stuff. I just always wanted to say that once. Subscribe, like, share, whatever. Whatever. Just get it out to folks so people can see it and hopefully help. But really do this. Make it your own. Again, this is not investment advice. I'm walking you through how I study models. You should make it your own. And if you come up with something better, I'm happy for you. That's great. I took, the way Bill did things, and it worked perfectly for him. He was a billionaire. I'm not, so his style worked for him. It didn't work for me, studying them the way he did them. So anyways, hope that helps. It's a 3-day weekend. We should have a 3-day weekend for Veterans Day, or at least have Veterans Day off every year. And nothing pisses me off more. New York Stock Exchange has some words for you that I don't want to say recorded. Make Veterans Day a day off and respect our veterans. And that's a big deal. And anyways, and thank you to my father for fighting in Vietnam and being in the Marines for 20 years. And anyone else who's a service member out there, I really should have gone in the Marines, and regret that I didn't, frankly. So that's a story for another day. So peace out, and hope you guys enjoyed this. Thank you.